Hi guys, my name is Benedict and I'm an accounting teacher. So recently I've had a lot of time on my plate since we haven't been that really busy at work because we're preparing for final exam, and I thought to kill some time, let me post a few videos or a few lessons to help you guys in preparation for your final exam. So what I'm going to do is post accounting related videos for grade 10, 11, and 12. But my main focus for now is going to be grade 12 since you guys are preparing for final exam. So for today's topic, I want to focus on the balance sheet, which is also known as the statement of financial position. Welcome to the very first video. So now, before we get into the first activity, I just want us to briefly go through the basics or the description as well as the purpose of your balance sheet. So the description of the balance sheet is in its name. It's called a statement of financial position. We as a business are trying to see how our finances are positioned. In other words, we're trying to see how our assets are financed. And the balance sheet takes on the equation of the accounting equation, which states that assets is equal to owner's equity plus liabilities. In other words, we are trying to see if your assets are financed through owner's equity or through liabilities, right? And again, the most important thing that I cannot stress enough is that you need to know your structure. You need to know each and every item and where each and every item falls under, right? These items, we call them notes. So they go from note number 3 all the way up until note number 9. We know that the first two notes, note number 1 and note number 2, they are for the statement of comprehensive income or income statement, and those two notes are the interest on income as well as interest expense. So before we go through an activity, let me quickly just type in the structure of your balance sheet. So you are going to have your assets. Total equity and liabilities. All right, so this is how your balance sheet looks like. This is the structure, and again, I cannot stress how much you need to know this structure inside out, because what most learners do is that they tend to think the answer book will come with these things already filled up for them. Now, sometimes you might have to do a fill in, but other times you will have to start from scratch. They will just give you a skeleton of the balance sheet, and you would need to fill it up yourself. And it always helps to know something inside out, even if you have to fill in. You won't have a problem when you have to fill in if you know this thing inside out. It doesn't, you don't lose when you know these things. Okay. So, as I've said before, it takes on the equation of the accounting equation, which says that assets is equal to owner's equity and liability. So let us start with our assets. We know that we have two groups of assets. We have our non-current assets. Now, these are the assets that will be in the business for more than 12 months, for more than a year. And we also have current assets, and these will be in the business, or the business expect to change them into cash within a year. So now, when it comes to the balance sheet in preparation of your fixed assets, what you need to know is that So this is our note number 3. Sorry, I forgot to write down the number of the notes. I don't know. Let me try to do that as quickly as possible. So with note number 3, we as a business, we want to see the movement of our fixed assets within that particular year. What we are going to do is that we are going to record our asset at cost less aggregate or accumulated depreciation. So we are going to record our assets in actual sense. We are recording them at the carrying value. We are recording them at the carrying value on the balance sheet. So it means that in order to do that, you would need to prepare your note number 3, right? And then we come to the second item, which is fixed deposit. Your fixed deposit is straightforward. It's always given on the trial balance. If not, we know you'd have to work it out as a balancing figure. But I cannot stress enough that when it comes to the fixed deposit, you will always come across an adjustment which will say that fixed deposit will mature within the next 12 months. If ever you see that transaction, even if it doesn't specify, let's say for an example, the financial period ends on 28 February 2023, and then they tell you that fixed deposit will mature on the 30th of September 2023. If you check, um sorry from 28 February 2023 until 30th of September 2023, we are still within the 12 months period. So what you need to do is that you need to subtract that amount which they say it will mature within the 12 months, and you are going to add it under cash and cash equivalents. I hope I'll be able to demonstrate this when I do the activity. So that is it with your fixed deposit. All you need to do is to take the balance that is given on the trial balance less the amount which will mature within 12 months. So now we come to inventories. So with inventories, this is the closing balance of your inventory. It's a closing balance of your trading stock, your stationery, your packing material, your consumables, and etc. etc. All you need to do, if you come across an adjustment which says that the after a physical stock count, the following was revealed: the closing balance for trading stock was X amount, and the closing balance for stationery was X amount. You are going to take those two amounts, you add them together, and you record them as your inventories. Right. So let us move on to note number 5, trade and other receivables. With trade and other receivables, you have a standard structure: debtors control less provision for bad debts. It gives you net trade debtors. You add your prepaid expenses, you add your accrued income. Prepaid expenses, these are expenses that have been paid in advance. We as the business, we can pay insurance in advance, we can pay advertising in advance, we can pay many expenses in advance. So those expenses, we record them as prepaid expenses under trade and other receivables. And accrued income is income that is earned but not yet received. So for example, if they tell you that the tenant has not paid the rent income for March, or there's an outstanding rent income for for January and February or something like that, then we regard that as an accrued income, which also falls under trade and other receivables. So again, it's your debtors control. You subtract provision for bad debts, which will give you your net trade debtors. You add accrued income, you add prepaid expenses to calculate your trade and other receivables. So now we come to cash and cash equivalents. Cash and cash equivalents is one of the simplest notes that you can prepare. You are going to take your bank, if it's a debit balance or if it's positive, you add your prepaid, you add your petty cash, you add your cash float, and you are also going to add that fixed deposit which will mature within 12 months. So that is your cash and cash equivalents. So those are your current assets. After that, what you're going to do, you're going to add the total of your non-current assets with the total of your current assets to give you your total assets. Now we come to equity and liabilities, starting with the first part, which is shareholders equity. Under shareholders equity, we have ordinary share capital. Ordinary share capital, it also has a format. Your format says you have your X amount, your X number of shares at the beginning, your X number of additional shares issued, minus your X number of ordinary shares repurchased, which will give you your X number of ordinary shares at the end of the year. I will also demonstrate that as we do an activity. And then we come to our retained income. Our retained income, in order to calculate it, you're going to have your opening balance, you add your net profit after tax, you subtract the above average or the difference, which is above the average price, the amount of money that you use to repurchase your shares. Then you also subtract your ordinary share dividends. Your ordinary share dividends comprises of your interim dividends, which are always paid, and your final dividends or your declared dividends. And then once you do all of that, you will get your balance at the end. Now we come to the liability side. We have the mortgage loan. With the mortgage loan, it's a bit tricky, but I find it very simple. What you want to do is you always have this thing called, or rather, they will tell you 50,000 of the loan will be paid in the next financial year. Now, a non-current liability means that this liability will not be settled in the next 12 months or for more than 12 months. So now if they tell you that part of the loan will be settled in the next 12 months, that loan, it therefore doesn't become a non-current liability, it becomes a current liability. So what you want to do is, there's a few ways that you can do it. The first one is that you will come across an adjustment on your additional information, which will say that the statement of the loan from Absa Bank revealed the following. And then you see you are going to have your opening balance. Maybe they will not show you your interest. Then you have your repayments including interest, and then you have the closing balance. The most important thing is the closing balance there. So you are going to take that closing balance from the statement, from the adjustment, right? Let's say the amount is 150,000. If they say that 50,000 of the loan will be paid in the next financial year of the capital amount, you are going to take that 150,000, you subtract 50,000, which will then be your current portion of loan, right? And then if it's not given the closing amount, what you want to do is you are going to check your trial balance. You will also have a closing amount. So you are going to take the closing amount from the trial balance, you add your interest capitalized, and then you subtract your current portion of loan. So let's say, for example, the closing amount on the trial balance is 120,000, for example. So you're going to take that 120,000, and we assume that the interest capitalized is 30,000. So you're going to take 120,000 from the trial balance, you add 30,000 of the interest, and then you subtract 50,000 of the portion of the loan which will be paid in the next year. And then all in all, the balance of your non-current liability will be 100,000. Right. So let's go to the last one, note number 9. I remember as a learner, I used to hate this note because it had a lot of things and it was confusing. But as I grew up and I became a teacher myself, I realized that no, man, they're just trying to confuse us. These things are very simple. So with your trade and other payables, your note number 9, what you are going to do, it also has a standard format. You have your creditors control. You are going to add your accrued expenses. You are going to add your income received in advance, and then you also add your creditors for salaries, which is the net salary of an employee who was excluded from the salaries and wages journal. And then from there, all you do is to add all other expenses associated to that adjustment of the employee which was left out of the salaries and wages journal for February 2023, meaning that you are going to have your SARS payee, the pension fund, the medical aid, the UIF, and the skills development levy if ever it's there. All right, so that is it with your trade and other payables. We also have shareholders for dividends. Shareholders for dividends, you calculate it when you prepare your retained income note. It is the shareholders which were at the final or the declared dividends. Current portion of loan, we have already spoken about that. And then bank overdraft, you only put it under current liabilities if ever it is a negative balance. And then we also have SARS income tax. Now with SARS income tax, this is the amount of money that we are owing to SARS with regards to the income tax for the year. Now what happens is that you will come across an adjustment which would say maybe after the tax assessment the following was revealed. 360,000 is the income tax for the year, which translates to 28% of the net profit before tax. So you know that the tax for the year is 360,000. Now we need to check the trial balance. The trial balance will show us the provisional payments, meaning this is the amount that the business has paid towards the tax. If that amount is lower than the income tax for the year, then SARS income tax will fall under current liabilities. Let's say for an example, the income tax for the year is 360,000. The provisional payments is 320,000. It means we paid less by 40,000. So your SARS income tax will be under current liabilities, and you are only going to record the difference, right? But if your income tax is 360 and it so happens that we paid 380, then your SARS income tax will be under trade and other receivables, and again you are only going to add the difference. So 380,000 minus 360,000, which is 20,000, that will be added under trade and other receivables. I hope you guys understood. If you have any questions, feel free to comment on the comment section. Yeah, feel free to comment on the comment section. Tell your friends to tell their friends to tell their classmates, their cousins, and so on and so on. And subscribe. That will show me that you guys want more content. And then, yeah, thank you.